So the stock market continues to be in a bull market. And from the lows made in October of last year, if you think about it, the bull market is now in its 5th month, more than 5 months in fact. But of course, that's not what most people will tell you. Most people out there, majority are bearish and they are still in denial and say, this is not a bull market, it's still a bear market. And they will tend to be in denial all the way to all-time highs. So that always happens in new bull markets. People are always very pessimistic, and bull markets are always born on pessimism and skepticism. Nothing new over here. But I always say that if it looks like a duck, it quacks like a duck, it walks like a duck, it's a duck, right? So if you see higher highs and higher lows in the market, hey, there's an uptrend. Who am I or you to argue? It is what it is. So if you guys remember, again, on the 15th of January this year, I called the bull market on the S&P 500 when the 50 moving average crossed above the 150 moving average, and both moving averages started flattening, sloping up. And now you can see that the 200 moving average has also begun to slope up, which really increases the probability that indeed we are in a bull market. But of course, it is not officially a bull market yet in the S&P, because by definition, a bull market is when prices close 20% above the lows made, and we're not there yet on the S&P, so it's still unofficial. But when it gets there, then I can say, okay, it's official, right? But by the time it's official, prices would already have moved up, 20%, But I mentioned recently that the Nasdaq, on the other hand, the Nasdaq is officially in a bull market because prices have indeed closed more than 20% from the lows of last year. And of course, same thing on the Nasdaq. You can see the 50 moving average cross above the 150 moving average. They're both sloping up above the 200-day moving average. It's a bull market in every sense of the word. How about the Dow Jones? Now, the Dow has been the laggard this year. Well, understandably, because last year, the Dow was the one that dropped the least. So this year, it goes up the least as well, whereas the Nasdaq dropped the most last year, and so it rebounds the most this year. They all take turns. Now, if you take a look at the Dow is not officially in a bull market yet as well. And if you look at the moving averages, you can see that the 200 has begun sloping upwards, and prices are above the 200, above the 50 moving average. If you have taken my courses, you know that that is actually my definition of a new bull market as well. Again, unofficial, until it reaches 20%. So for those of you who are invested in the highest quality companies in the markets, you should have seen pretty good gains so far this year to date. So in the name of transparency, you can see my portfolio. Year to date for the first 3 months, I'm up 18% on one portfolio and 20% on another portfolio. I've got two main US portfolios. So I'm up roughly about 840,000 US for the first 3 months. Taking into account the $99,000 of deposit I made. So less that, still up $840,000. Now, some people will say, hey, but that's just a short term. Yeah, you're up 20% in 3 months, but how about last year? Your portfolio went down last year. So sure, let's take a look at it in a broader perspective. So over the last 4 years, you can see that my portfolio is up 101%. It's the one in blue versus the S&P 500. So 101% over 4 years is roughly about 19% compounded annual returns per year. And my average return a year is usually about 25 to 30%. But you can see in the last 4 years, it's down to only 19% a year because of the drawdown that we went through last year. But again, take a look at how markets work. You go through drawdowns, rebound, drawdowns, rebound. So now we're in a process, of course, rebounding in the new bull market. So once it starts to rebound, my returns versus the S&P 500 would go back to a normalized 25 to 30% return a year. So that is what you should be achieving yourself if you're invested in the top 1% of companies in the world, which is what I teach in my courses, and you add shares only when they're deeply undervalued, which is what happened last year and in fact early this year. So again, a common question I'm getting from many students is the stock market getting overvalued? Is it time to sell before I lose those gains? Well, it really depends on the individual companies. I would say that within the market, there are some companies that are overvalued and some companies that are still undervalued. So it really depends on a case-by-case basis. Now, whatever it is, remember that even in a bull market, prices don't go up in a straight line. They move again in wave patterns. This is something I teach all the time. So again, remember, wave up, wave down, wave up, wave down, wave up, wave down. Now it's wave up, right? So at one point, guess what? It's going to wave down again. You know, I can't go up in a straight line. But as long as the market makes higher highs, it makes, you know, higher highs and higher lows, the uptrend is intact. The bull market is intact until the trend reverses down. So people always ask me, hey, how long does a bull market last? No one can predict. It could last for a year, it could last for 5 years, it could last for 9 years. You know, we can't predict that. But when it reverses into another downtrend, then we can see from the charts and then we take appropriate action. Now, having said that, let's look at some individual companies. So, example, let's look at Nvidia, which I have in my portfolio, as you guys know. So is Nvidia overvalued? Yes, it is. It is overvalued. So you can see that my intrinsic value for Nvidia is about $200. Now, some of you would say, how do you get the intrinsic value? Well, that's our proprietary technique where we calculate the intrinsic value using our intrinsic value calculator. So of course, in our courses, the Wealth Academy Masterclass and my value investing course, a big part of my training is to teach you how to calculate intrinsic values of any company. Because once you know what it is worth, you know when it's expensive or cheap. And of course, if you're too lazy to calculate it yourself, you can join my Ultimate Investors Playbook, which is a subscription where I do all the work for you, I calculate all the valuations for you, and I update you every month. So anyway, so my intrinsic value is 201. So Nvidia currently at $279. So in other words, if you take 279 minus 201, Nvidia is about 39% overvalued. So the question is, it's overvalued. I own it. By the way, my average price for Nvidia is about $150. So I'm up like about over 80% return. Should I sell it? That's a common question I get. Now, in the old days, back about 10, 15 years ago, I used to sell a stock once it got overvalued. And I said, okay, hope it comes back down, undervalued, I buy it back. And I used to do this with Apple and many other companies. But over the years, I found that there were many times after I sold Apple, for example, when it's overvalued, you know, it came down a bit, but then it kept going up and I could never buy it back because it kept staying overvalued for years and years and years and years. And so I realized that if I just held on to Apple, instead of like jumping out and getting back in, you know, today I'll be a lot richer. So nowadays, I think a bit differently. So here's the thing. It depends on your time frame. If you don't need the cash and your time frame is to hold for 5, 10 years as an investor to build your retirement, then you don't have to sell Nvidia, for example. Why? Because yeah, it could be overvalued in the short term, could be overvalued, right? And it may come down, you know, a bit, right? Maybe 10, 15%, but eventually it's going to go back up again, you know. And as a great company like Nvidia, remember the intrinsic value will keep rising. So even though it's overpriced, the valuation will eventually catch up to the price. And the trouble with trying to, it's very tempting to want to sell and buying it back lower. You know, everyone wants to do that. Who doesn't want to do that, right? It's a very overwhelming temptation to do that. But the danger by doing that as an investor is many times, again, you sell and it may go down a bit, right? But before you get a chance to buy back, it zooms up again. And then, you know, you miss out on, again, huge gains over time. Now, having said that, I do tell my students that if you need the cash to buy something else, you need the cash for your expenses, or you're currently over leveraged, then yes, now's a good time to sell Nvidia. Because why? It's overvalued. So, and it may come down, retrace back down before it goes higher. So it really depends on your situation. Again, if you need the cash, you may want to sell a third, a quarter, or half the position. But if you don't need the money and you have a 5-10 year time frame, let it compound. So it's different for different people. So what do I do? Right? So for me, what I do is, because I use options, I use covered calls. So what I did yesterday, for example, was I started selling covered calls on Nvidia. In fact, I posted this in my community. I always share my option trades with my community. And let me just share with you the the alert I sent out yesterday. Let me just look for where it is. There we are, right? So over here it says, this was sent yesterday. I said Nvidia is overvalued and a bit overextended, a bit far from the moving averages. So after a wave up, we expect a bit of a wave down in a while. So, investors who want to raise cash could take this as an opportunity to sell, to take some profits. Personally, I'm not selling the stock itself because I don't need the money and I'm willing to hold for the next 5-10 years. I'm fine with that. But I'm selling covered call options to take advantage and make some money if it comes down or goes sideways, right? So I sold covered call options at 295 strike price. You can see my screenshot, right? And I collected a premium of $9.50. So what does it mean? When I sell a call option at a 295 strike price, and there we are, that's my line over there. It means that if in 40 days, my options expire in 40 days, right? So in 40 days, if Nvidia closes above 295, then I'll be obligated to sell my shares at 295, which I don't mind, right? Because again, I bought it at 150. If I end up selling at 295, hey, I make a good profit, correct? So if the price goes up and my options get assigned, I'll happily sell the shares at 295. But remember, by selling the option, I collected a premium yesterday. And I collected a premium of $9.50. So not only do I sell the stock at 295, but I keep the premium of $9.50. So my net sales price for Nvidia will be $304.50, which is not a bad selling price because I'm selling it when it's overvalued and when it's a bit overextended. So when it retraces back down, I could always buy it back later on. Now, but if Nvidia doesn't stay above 295 in 40 days, let's say Nvidia, comes down, for example, or, goes sideways for 40 days, and it doesn't stay above 295, what happens? The options I sold, the call options I sold will expire worthless, and I keep my shares. I don't sell my shares, but I get the premium of $950 contract in my pocket, right? So that's the great thing about selling covered call options, that it's a win-win situation. If the stock price goes up, you end up selling your shares at a very good profit. If the price doesn't go up, you keep the shares, but you get free money by selling the call options. Now, let's look at another stock which I own in my portfolio, which is McDonald's. I've been holding McDonald's for quite a number of years as well. And my average price for McDonald's is pretty low. My average cost is $179. That's my average cost. So right now it's way above my average price, again, sitting on a lot of profits for McDonald's, okay? But again, McDonald's is something that I don't mind holding for the next 5, 10, 15 years to grow my wealth. But short term, you can see that it is overvalued. You can see my intrinsic value for McDonald's is $249. Now McDonald's is at 282. So you can see it's overvalued by, let's see, 282 minus 249. Roughly it's about 13% overvalued. Okay, not that bad, slightly overvalued. But if you look at the price action, you can see that it's a bit overextended. Can you see that? Right? Remember, wave up, wave down, wave up, wave down. Now, when you see a wave up that goes 90 degrees, like that, it tends to retrace back down quite a bit. So look at McDonald's, right? Wave up, it's like really extended, right? So looks like soon it's going to retrace back down before going higher eventually. Yeah. So same thing. Should I sell McDonald's? And again, the answer I told my students yesterday was, if I need the money to buy something else, I need the money to buy my wife a new car, I'll sell McDonald's because it's overpriced, right? But if I don't need the money and I want to build my retirement in 20 years, McDonald's will keep going higher eventually. I'll keep it, right? But again, what I did was I sold covered call options on McDonald's as well yesterday. And again, all this I share on my subscription, UIP subscription. That's where I posted over here. Yep. There we are. All right. Yep. So this was my thing over here, right? McDonald's is overvalued, parabolic, went up 90 degrees. Investors who want to raise cash could take this opportunity to sell, but I decided to sell covered call options at 285 strike price, expiring 19 May, and collecting $6.53 shares, $653 in premium. All right, so the same thing. By doing that, what happens is if McDonald's keeps going up, closes above 285, I end up selling my shares at 285. Plus keeping the $6 premium, I end up selling at about 292, which is a pretty good deal because my cost is really, really low. But if McDonald's doesn't go up, McDonald's like comes back down or goes sideways, I don't end up selling my shares, but I get free money selling call options. So that's the great thing about combining options with investments, right? Selling covered call options creates additional stream of income while you're waiting for your great stocks to consolidate or to retrace before going higher eventually, right? Now, having said that, there are also stocks that are still very undervalued. Example, Meta. Meta has gone up like 100% from the low, but fundamentally Meta is still undervalued. So again, if you look at Meta, you can see my intrinsic value is between 285 to 319, and at 213 it's still very cheap. It's still very cheap, and you can see that Meta has started its confirmed uptrend over here. You can see this was a clear downtrend, and this is an uptrend, right? Clear uptrend, right? So it's like again wave up, wave down, wave up, wave down, wave up. All right. So sure enough, it doesn't go up in a straight line. Okay, you can expect Meta along the way to wave down again, right? Wave up, wave down, wave up, wave down. But eventually it'll get to or beyond that intrinsic value. So for example, of Meta, what will I be doing? Am I selling? No, I'll just hold Meta, still cheap. And would I add more shares? I would add more shares if I see the next wave down, the next retracement. Yeah. If I don't yet have a full position on Meta. Another example of a stock that I think is still really cheap would be, for example, now let's take a look at the last example, which is Mercado Libre. I own this in my portfolio as well. It is the largest e-commerce company in Latin America. It's kind of like the Amazon of Latin America. So Mercado Libre fundamentally is undervalued. You can see that the intrinsic value that I calculated is about 1448. So currently at 1313, it's still cheap. Now, but it's one of those where it's cheap, but I won't buy more at this price. But neither would I sell. Why? Because if you look at the charts, fundamentally it's undervalued, but the charts are short-term overbought or overextended. And again, what does that mean? Overbought means that short-term, it's a bit overstretched, like a rubber band, right? Rubber band, you stretch it, it snaps back. Yeah. And you can see from the price action, you can see, wave up, wave down, wave up, wave down. And during this wave up, if it gets like a bit 90 degrees, a bit extended, you expect a wave down. Now again, the thing is you can't always predict exactly when it's going to wave down, right? Sometimes it could go up even more and then wave down a bit and go up even more. So the danger is always, hey, why don't I sell and buy it back lower? Sometimes you can't get back in fast enough. You sell, it flies off without you, or you sell, it goes down, but before you can buy it, it reverses back up again. So again, whether you sell really depends on your reason for buying. Again, if it's something that you're investing in for the next 5, 10, 15 years, you're building your financial freedom, it's a great company, you hold on to it. But if you are a short-term trader, then it's a different story. It's a short-term trader, you get in with very specific stop losses and profit targets, right? If I were to take this as a short-term trade, I would, buy somewhere here. After you see it, it consolidates and it breaks out. I could buy somewhere here, put a stop loss there, put a profit target somewhere there. The moment it hits my profit target, I'm out, get out. So you have to distinguish against between, trading and investing. I find a lot of people watching my channel, they get very confused. Many times they say, I don't know if I'm an investor or trader, right? So if you don't know whether you're investing or trading, you get very, very confused. You have no idea when to take profits, when to cut loss, or whether to buy more, or whether to hold on to it. So you got to get clear, first of all, on your approach. Whether you're investing or trading, have a clear investment or trading plan. And that's what we teach in all our courses, whether our professional trading course or our professional investing course. And that's what people learn in these courses. So hope you enjoyed it, and I'll see you guys in the next video. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.